these principles. It doesn't do an estimation up front. Okay, but it's very risky because some of the accounts may be past due until next season. So you will have expense estimated in 1 year and sales revenue recorded last year. Okay, remember matching principle, we always want to estimate in this accounting cycle the expenses that happened and then subtract it from this year's sales revenue or service revenue. In this case here, if uncollectible account expense was recorded next year, but it really relates to last year's service and sales, this is one of the principles that is violated using direct write-off method. Now, under direct write-off, once the company decides which are the customers are bad debt customers, when they write off that entry using uncollectible account expense, reduce accounts receivables, if later on again, if the customer has enough cash to pay back this accounts receivables, we also want to recover these accounts. So in terms of recovery, really the concept is very similar to allowance method. Again, we're flipping the previously written off entry and then journalizing a regular cash collection entry. Okay, so this last step here is exactly the same as this recovery entry here. The concept is exactly the same because we're trying to erase previously the written off entry. So under direct write-off, we also want to erase this. We will be flipping this and collecting cash, reducing accounts receivables.